everybody. Welcome to the TraderMerlin show. It is your Wednesday edition. A lull in the action. Markets were kind of, well, at least for me, they were kind of boring today, although we did have the NASDAQ break through those levels we talked about the highs on yesterday. We'll get to that here in just a second. I've done my best, which is really not the best effort in the world, to get Scott McCormick on the program more frequently. He loves to do a thing called the B.E.C.C report, which for the first time in the history of having Scott on the program, I'm actually going to get it correct today. For those of you who may not know what the B.E.C.C report is, tuning in for the first time, the B.E.C.C report is something that Scott does, which identifies kind of trends, issues, concerns, or just boredom in 4 major asset classes. And it's bonds, equities, commodities, and currencies. For some reason, I got that last 2 part wrong for the better part of the last 4 years on that bad boy. But we'll talk about bonds, equities, currencies, and commodities and currencies today with Scott McCormick, CMT, joining me from the great state of Texas. Scott, how you doing, my friend?
I'm doing well, Merlin. How are you?
Fantastic. Any better, I would be twins. What the heck's going on? I just looked back at the show, and the last time we had you on was January 19th.
That's serious? It's been
February,
that long?
March, 3 months without Scott. I'm going through withdrawals over here. I need to go to Betty Ford Clinic and say, hey, I need my McCormick addiction. I know I'm a
hand you a bottle of McCormick spices.
There you go. Your stock is doing very well, by the way.
MKC.
That it is. What's new in your world, man? How you been?
Just I don't know if there's anything really new. Just same thing basically. Month in, month out, quarter in, quarter out. Just took a little bit of time off last month. Went out to Disney. Taking off some time here next week. Going out to Boulder, Colorado. Going to get some hiking in. But other than that, just trying to navigate these markets like everybody else.
Wow, Disney. I knew you're a Disney guy. Are you the grown-ass man who walks around with Mickey Mouse ears on? I just got to know.
No,
okay.
No. I don't have that type of gear, although I did get a special T-shirt for the tequila bar, which for the longest time was unknown in the Mexican temple there in Epcot.
Wow.
And believe it or not, for as much as I'm a fan, I can't recall the name of it off the top of my head, but it's a cartoon drawing of Donald Duck in a margarita glass.
Wow.
It's kind of funny, but yeah, they have a great tequila bar there, and it's fairly hidden. So
it's called La Cava de Tequila.
Yeah, but it's definitely popular now. They've got lines going into this place.
Well, so. Nice. That's probably a little bit more formal than your lower back tattoo of Goofy, but we won't tell people about that one.
We don't want to talk about Goofy. He and I go back
way back. All right, let's start things off with your B.E.C.C report, kind of obviously with the letter B, looking at the bond markets. And, you feel free anytime you want to share your screens. I'll be dancing along with the charts as well. I guess we could start with maybe like the 10-year, which, really for the past 5-6 months hasn't done much. Feels like it's stabilized slowly, maybe drifting lower. I mean, you see some lower lows, lower highs on there, but any clues that you can give us about what the bond market might be telling us?
So last week I did a general session XLT, and kind of really went into depth with this with our students. And it wasn't a full B.E.C.C report. We didn't have that much time, but one of the things that really kind of came out of it is that we're still probably in stage 6 of Martin Pring's economic business cycle, right? So there's 6 stages. 6 is kind of the latter stage in a recession. And one of the big things that this business cycle, economic cycle really kind of looks at is the asset class rotation, right? And it starts off with bonds, hence the B.E.C.C report: bonds, equities, commodities, and then currencies. And so the rotation basically takes place in that order: bonds, equities, and currencies, or bond, equities, and commodities. I'm doing it to where when we start to look at like what asset classes would or should bottom out first, going from like a stage 6 into a stage 1, where that cycle starts to begin again for the expansionary phase of an economic cycle, it's bonds that typically kind of kick it off. And when you look at the 10-year, and granted, this is on a continuous chart, so take it for what it is, but there was basically an area of demand back from 2007 that we came back to this past October 22, and it's been basing around since, right? Now, one of the kind of key takeaways in last week's session was watching some of the key levels within the bond market to say, look, it's like right now the trend is still down, and yes, we're basing around this area of demand, but until we take out this key level, which for the 10-year would be about 122.02 on the weekly chart, there's a pretty critical swing high there that would really indicate that, okay, the downtrend that's been in place since 2020, that's done, right? Now, of course, I think a bigger reason why we are probably seeing the price action that we're seeing over the course of the past few months is because Capitol Hill is looking down the barrel of that debt ceiling and whether or not we're actually going to let this thing default for the first time in American history. So I think there's probably some caution around putting on any new long positions here. And I didn't take a look at the CPI data today that came out. I know you probably already have that figure here, but the trend in CPI has been showing signs of kind of cooling off here over the past few months, right? So the question becomes now, whether or not the Fed is going to continue to raise the rates, which could continue to put pressure on bonds. But if we start to see them kind of back off on that gas pedal a little bit, then maybe interest rates will turn a little bit lower. But keep in mind that if we do enter into this default situation, you're probably going to see interest rates spike. Mm-hmm. Bonds are going to collapse, because people are going to require that they earn a higher interest rate on those types of issues.
Right, for higher risk. It's gonna be higher risk. Yeah, I need better rate of return on that.
Yeah. I mean, even though it's the US government, right? I mean, we're probably good for that money, but it would be a very interesting transition, especially if we do see a weakening dollar on top of spiking interest rates. That would really put us into an incredibly inflationary environment. And the Fed's work just would not be done. So
did you happen to catch the comments? I don't know if you know who Brad Sherman is, but Senator Brad Sherman was Capitol Hill today going off on cryptocurrency and just saying, these crypto boys are just printing money out of thin air, and that's illegal. You can't do that. But we're the U.S. government. We can do it. And it was
right, we do it every day.
It's just kind of comical to hear him. I think he had the quiet voice inside of his head. Had Tourette's at that moment because he was probably thinking, "Well, we can do that," and then just vocalized it and probably was going, "Oh crap, I didn't mean to say that." Shoot, everybody knows it, Brad. Good luck in getting reelected, though.
Kind of makes you wonder if it was just projecting,
Yeah, exactly. We look at. I'm actually going to bring up a couple different things here. I know you can't see this, but you mentioned with that CPI number drifting down, and it has certainly dropped quite a bit, although it's still at 4.9% year over year. So it's still nowhere near the mandate of 2%, which the Fed has been targeting. So I'm just bringing this chart up here, guys. This is the Fed funds futures, which we look at a lot here. And if you notice the 6.1% now of a 25 basis point increase, this has been slowly creeping up. And I, for one, I do feel they're going to pause. I think they're just going to pause the next meeting. But the more that we see inflation not kick back down as much as they thought, we'll start to see this probability jump for a 25 basis point increase at the next meeting. So there's certainly a lot of fluctuations in that, but right now the general expectation is that they're going to hold and stay the same. And I agree with Pepe Garcia says, I think that the CPI number is BS. Well, I do as well, but that's all we have to go off of is the information that we're given, and there you go.
Yeah, and that's the thing. It's like look, we could debate all day long on the validity of the information that the government puts out, because you're going to have those that just don't believe it, and that's fine. But what else are you going to go off of? Right. It's like you can collect all the data that you want to, or Just look at the information maybe with a skeptical eye and see if the price information in the asset classes that you're actually trading are reflecting your beliefs about what inflation actually is, right? Because there are those that would enter into a market environment with a particular bias based on a certain belief or certain set of data, and they're going to position themselves based on that. But that doesn't necessarily mean that they're going to be right in the markets. I say it all the time in my sessions that price is king. And if you're long and the market goes up, you're going to make money. If you're long and the market goes down, you're going to lose money, and vice versa, regardless of what your beliefs are. So at the end of the day, if I look at data and I'm like, whatever, that number is still way too hot, or it's too cold, I think it's higher, or I think it's lower than where it is. It doesn't matter. It's just at the end of the day, let me use the price in a way to confirm what it is that I'm seeing. And if it can't confirm it, right, if the price is actually doing something counter to what I believe should be happening, then that tells me that I'm wrong, not the market. So it's kind of the beauty of it all.
I'll run through a whole bunch of commodity charts here in just a second, because I think that is pretty key here, especially in looking at where CPI may be headed in the future. And as Chase says, the next CPI report is going to come out June 11th, and we have the FOMC June 14th. So they will have one more set of data, but most likely they will already have established what they're going to do by June 10th.
And keep in mind too, because I know you've got a lot of listeners and things like that. When it comes to the Fed, I'm sure that they look at the CPI data. I think it would be ridiculous not to, but the inflation number that they watch a little bit more closely is the core PCE, and so that next report's going to be out on May 26th. So that's something to be mindful of, right? And when you take a look at where the core PCE is, core PCE on the last reading was 0.3, and that is basically in line with where it's been over the course of the past decade, with the exception of 2021 and 2022, when we actually saw it spike up to about 0.6 and 0.7. So be mindful of the reports that are being used in their decision-making process.
Yeah, I may have mentioned this one to you before, but John O'Donnell and I, when we used to do the Power Trading radio show, we interviewed a guy from the Bureau of Labor Statistics, and I just threw out there, do you guys, change the data or modify it? And he says, yeah, absolutely. I was shocked that he answered that way. And he says,
all the time.
He goes, we tweak things to fit a political agenda. And I was like, wait a minute. How am I supposed to trust your data as a trader? And he says, well, you just have to take it for what it's worth. And I'm like, well, okay, that doesn't help me very much here.
Nope.
All right. So bonds.
And can I just say really quick, that is absolutely every reason why you should not trade off of data releases.
Yeah. I learned that lesson the hard way. I remember back in the late 90s, early 2000s, where I would be waiting for the announcement, and the second data comes out, oh, it's good CPI number, boom, I'm going long the market. All of a sudden, you're like, wow, I just got my teeth kicked in like 30 seconds. What happened here?
You'll get your face ripped off that way.
It will happen. Not a good thing. Definitely not. All right, let's keep moving down our list here. I know we tend to love to go into these topics, which we could dive deeper into. But second on our list here, equity markets. Over the past, I guess the past few weeks, we're looking at 4 months or 3 months since the last time you were on. But over the past, few months, we've had a slow drift up. I'll bring up the markets here.
Yeah.
We've had a slow drift up in the equity markets, seemingly stable, but most of that volatility seems to have disappeared. It kind of slowly traversing to the upside, especially things like the NASDAQ. What's your take on our equity markets?
So again, going back to that whole cycle, right? So one of the things that really kind of came out of last week and emphasizing like where we are versus what we should be looking for, right? Because if the markets are a cycle, okay, what do we know about cycles? They repeat. The amplitude and the duration might be different, meaning like how much expansion or how much contraction and how long that expansion or contraction might last. However, we generally tend to see that same rotation, which is why people like myself look at these things. So when I'm looking at the current situation, right, it's a matter of, okay, well, what has to happen in order to confirm that we're still in stage 6, and I should expect lower asset prices on bonds and equities, or vice versa, moving into stage 1, which would be the next stage. What do I need to see? And so when you take a look at where the equity market is right now, and I always do this at the end of the month, right? Because I've got end of the month data, I've got monthly candles that have closed, and I can look at that with more of an objective eye. And so when you take a look at where the equity markets are on the monthly chart, there's the high from August of last year, August 22. In and around that. And keep in mind as well, I'm also looking at the cash index. I'm not using futures. I'm not using the ETFs. But 43.25 is a pretty key area there, the high from August of 2022, that we need to get beyond in order to tell me that, yes, we're moving on to stage 1, possibly even stage 2 of the cycle, which should be more bullish for equities. But then on the downside here, what you're going to notice, as you pointed out, is that, yeah, we've really been going sideways here for going on 6 months, basically, since November. I mean, last month we did close outside of the range from March, but we still haven't gotten out above the highs from February to really kind of suggest that potentially we're breaking out. And even if we do, we still need to get above that 43.25 area to say that we've terminated that weekly downtrend, which is basically constituted the corrective phase of the longer term bull market since 2009. So when we take a look at where we are on the downside, and this is kind of the scary part here, is that if this rally that we've seen basically since October of last year has been corrective in nature, and we're to expect another down leg before we really kind of see a bottom put in, the lows there from December at 37.64 would really provide a support level that if we do see, for instance, like a monthly close down below that area, that would indicate that we're probably moving lower to about that 2860 area. Let's just call it 2900 on the S&P. Whereas if we manage to get out above that 4278, I've got targets in around 6100 on the S&P. And I know people, right? It's like that's always the reaction that I get on these targets. But we're also, we have to remember that information is based off of monthly charts, and that those are targets that are targets that you would probably see over the span of a couple of years, as opposed to a couple of quarters.
Yeah, I'm mapping it out now. Yeah, I would hope so. 47% increase to get to, from current levels, to get to 6,100 would be a 47% gain, which I think would catch a lot of people off guard. It appears to me, and I'm curious what the viewers think as well, but it appears to me that at this moment in time, there is an abundance of pessimism. The recession word keeps getting thrown around. You hear the depression every now and again. And, it always goes back to the old saying that when there's blood in the streets, you want to be greedy, be greedy when others are fearful. That kind of begs that question. How do you look at that? If we have all this kind of negative talk track out there about our markets and inflation, and, we're headed into a depressionary cycle, a recession, how would you look at that and incorporate that into your investment or trading decisions?
Can I quote Jim Cramer?
Oh boy, you're really pushing buttons today. Of course you can. You can do whatever you want on the show.
There's a bull market somewhere, and the fact of the matter is that there's, when we have periods in time like after the COVID bottom there in March, April of 2020, going into the highs there in late December 21 and January, February 22, we saw large percentage gains in a lot of stocks. I mean, in a large percentage. When we look around right now, obviously there's fewer stocks that are trending higher, but they're out there, right? It's kind of like the X-Files, right? The truth is out there. You just have to go and look for it. So when I'm looking at where we are right now, would I expect broad participation in a market rally? The answer is no. Would I try to take advantage of people positioning for a downward move in the market? I think that what I would need to see is evidence that they're wrong first, right? And it kind of takes me back to just basic market mechanics, right? So there are those, there's two types of buying and there's two types of selling, right? So in options traders, that they really kind of get this because the terms in themselves are the actions that you're actually taking. So for instance, I can buy to open a position or I can buy to close a position, right? If I buy to open, I'm going long. If I buy to close, then I'm getting out of a short. And vice versa. I can sell to close, which means that I'm getting out of a long, and I can sell to open, which means that I'm opening a short. And so just in taking a look at these levels that I shared, 42.78, 37.64, if I have a lot of people that are out there, for instance, that are looking at a lot of economic data that's pointing to a recession, and they're trying to position themselves in a way to take advantage of the next decline, which just really hasn't materialized yet. If they're building short positions right now, helping to keep the market from advancing higher, but the market does advance higher, we have to think about what's going to happen to all of those individuals that have positioned themselves short. You know, when you're short selling, it's unlimited risk. The market can go up infinity. So they're either going to have to hedge themselves through, let's say, S&P futures, just for the simplicity of it, or using some sort of option strategy, or they're going to have to cover their positions, all of which is going to constitute buying in the futures market, the options market, or the equity market,
right,
which could put a lot of pressure to the upside, and vice versa. Right. So, you know, anybody that's building long positions over the course of the past 5 months, you know, breaking down below that 37.64, that's probably going to initiate a lot of selling inside of the market. So for me, it's a matter of understanding where those key levels are that either long or short participants would be wrong.
If you know, in a situation like that, you mentioned that 37.64, and here we are sitting at 41.37. So you're clearly a 400-point drop. That's roughly 10%. That's a lot of meat on the bone, if you will. And I know that might be a trigger for you to sell. What about some of these other levels that may be relevant for, I guess, discerning that things may be changing? So for example, you can look at this, call it the 40-50 mark, which is really the zone that's right below this last month of sideways action.
It's the lows from the past month and a half. Yeah.
Do you start to use those as kind of, okay, well, if it breaks the 40-50 mark, I'll start looking more bearish. If it gets down below 38.20, now I'm really feeling more bearish. It breaks 37.64, now I'm all in short. I mean, are there stages to I guess, scaling into a change of direction for you?
So it really depends on what the broader market context is, right? So I'm and your listeners have to understand that when I do the Beck report, I'm going back as far as I can in my data. As a matter of fact, I'm looking at a chart of the S&P 500 that I've got swing lines plotted going back to the lows in 1932. And
there's still orders there. There's still orders sitting out there.
Right? I mean, the PE ratio at that level would be insane.
Yeah.
So when I'm looking at where we are right now, right, what goes through my head as a technical analyst is that the trend for the last 14 years is still up. The trend for the last year and a half has been down, but the trend for the last 6 months has been sideways. Okay. So that downtrend, in my mind, from December 21 going into the lows of October 22 was a corrective phase of the overall macro bull market or secular bull market that I just referred to from the lows in 2009 to 13. So if I were to see a 10% decline in the market relative to that long-term trend, that's nothing.
Right.
Right.
Yep.
Now on the other end, on the other side, right, let's say, for instance, if we were in a clear downtrend and I saw these areas, let's say at 40-50, yeah, that would be absolutely a signal to go short. Now, a lot of this really depends on whether you are long or short. For those that have, for instance, a long portfolio and they know that 40-50 is a key level inside of the market that could result in the S&P 500 declining down to about 3,700 or worse, then initiating a hedge against that long portfolio at that level would be prudent.
Right.
right? So in essence, going short on S&P futures or initiating some sort of delta neutral strategy through options against the long equity portfolio, so that as the market declines, you're neutralizing most of that decline, if not all of it, right?
Yep.
So a lot of that really just comes down to like understanding notional value and how many contracts you would actually have to do to neutralize your long exposure. But when we're looking at this right now, what I see is, again, going back over the last 6 months, basically, we've been in a sideways range. So if we do break that 40-50 area, I'm looking for a move back down to about 38.50 down to 38.26. And that would not change the short-term trend that we've seen over the last 6 months. But breaking that 37.64 area, that is a key level on the daily charts, on the weekly charts, on the monthly charts. And getting down below that could result in a further decline to about 28.68. So would I be willing to give up 10% price movement to experience another 900 points to the downside?
Right.
The answer is yes.
Yeah, and I'm typically, and I say that almost as an exploratory question, because 10% might be a bit to leave on the table, but I guess the older that I get and the more that I trade, the more I'm like, I'm cool to leave money on the table. I have no problem whatsoever, as long as the piece that I'm targeting is worth it for me and there's enough to make my reward worth the risk. So yeah, it was certainly there's no right answer there. It's also a matter of personal preference. I know some people are going to take that as soon as it gets below 40-50, they're shorting the hell out of it. Whereas I think most are going to be a little more cautious.
And I think a lot of it really comes down to what your trading style is.
Yep.
As a short to intermediate term trader, let's say if your average hold time is measured in terms of days and weeks, right? Even maybe a month, then yeah, you need to pay attention to that area. That 40-50 level. But if your time horizon is measured in the span of years,
yeah,
that's a little different.
Yeah, absolutely. All right, I'm going to try to keep things moving here. So we talked, if we look at this B.E.C.C report, bonds, equities, talked briefly about those two. The one that at least personally, I find the most interesting is what's going on with commodities. And I'll run through just some pictures here for everybody, just so I can get them out of the way and kind of set the stage for wherever Scott would like to go, since we don't rehearse this. It is just really open-ended. But some of these commodities have had just absolutely ridiculous moves over the past few months. So let me start things off. I've got a list of commodities here. I'm just going to go through. Here's sugar, which I was joking with Scott before the show about the price of sugar. He's like, man, my Pepsi just keeps going up in price. But you try to buy a 12-pack of soda now, you may as well just buy a 12-pack of beer. It's cheaper to buy the beer than it is the soda, because sugar has just gone parabolic. Really, this year, it's gone absolutely bonkers. So sugar, huge surges up. But then on the flip side, you've got corn, which over the past month has just been absolutely rocked from 682 all the way down to 594. You got lumber, which, I mean, this is one of the most beautiful downtrends you'll see for about the past year and a half. Has just been down, 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 down. We were up at 1359 on lumber. And now we're at 348. It's dropped $1,000, or 1,000 points, I should say. Cotton, sideways action. Wheat, again, huge drift down. It's over 50% decline in wheat for the past year. You've got, what do we got? Soybeans. You got natural gas is just absolute murder scene. And then one that you love to look at, which is this Thomson Reuters CRB commodity index. When you were on in February, it was rallying really strong, and you would voice some bullishness on that one, saying, hey, yeah, I think there's more upside here. Well, it peaked out of about a few months after. Actually, no, that wasn't when you're on. You were on in 2023. It's just been on this slow drift down now overall for commodities, and I think this is certainly having an impact on CPI. Is there any commodity issues that, I know you like to look at copper and some other ones, that really stand out to you as being influential from a commodity perspective?
So the ones that I typically look at when I go through the B.E.C.C report are the ones that are generally more economically sensitive. So copper, obviously, crude oil, gold. But as you just mentioned, I mean, all of these softs and ags, those are important as well. And so when I'm looking at the CRB, part of the reason why I use that is because it's more of a balanced index when it comes to commodities. Because when you start to go through the world of commodity indexes, there's not a ton out there, but some tend to be more heavily weighted towards metals. Some tend to be more heavily weighted towards energy, and so it can kind of skew your perspective a little bit. And if I'm not mistaken, the CRB is one of the older ones. Like the chart that I've got goes back to 94. But you're right in that, what we've seen here is this slow drift. It ran into an area of supply back in April, May of last year around that 309, 326 area. And so far we've been in a nice little correction. But what's interesting here about the larger macro picture, like again, I'm looking at a monthly chart of commodities. And when you look at the monthly chart here for the CRB, the longer term downtrend that was in place from 08 going through to the lows there in 2020 was terminated back in 2021 and January, February of 2021. And so far what we've seen is a pretty nice retracement of that decline from 2011 going down to 2020. So nearly a 10-year decline. The key thing that I'd be watching here for the commodity index is whether or not we do manage to get above that 372 area on the monthly chart, because that is that's the swing high from April of 2011 where it topped out last, and would actually give us more of a secular bull market within commodities, whereas the bull market that we've seen since 2020 has been a little bit more cyclical in nature. On the downside here, if you're a follower of market polarity or old resistance becoming new support, the swing high there from May of 2018 at 206 is a pretty key area. And there is an area of demand there that had an immediate retest back in November 2021, but that zone is sitting at around 219 to 204. So what I would really be paying attention to here are kind of those levels, right? But one major element here, and I don't know if you have the ability to do this or not, but if you can, I would suggest it, is adding on a chart of the dollar index, because when you take a look at the dollar index, obviously the dollar's been pretty strong.
You just want the Dixie?
Yeah, I would use the one from the ICE US exchange if you're on TradingView.
Yeah, well now you're putting me on the spot. Yeah, it's, just the DX. Yeah,
the DXY. Yeah, DXY is the ticker symbol there.
Yeah,
but yeah, when you take a look at the dollar index there, what's fairly interesting, and let me do that myself here because I keep them in separate charts. But
there we go.
All right. Just one line.
So, and as you guys know, I've been artistically following along with Scott here. So from that peak that we had on this commodities index going back into July of 2008, that's a remarkable decline of 78%. Pretty crazy. And I actually drew some fib levels on here just to kind of see. And this most recent retracement that we've had, this huge surge since 2020, that came right back into a 618 retracement for those fib lovers out there. Let me get the colors off the screen. Now what I have here is the Thomson Reuters Commodity Index with the dollar index across the bottom. So now I've got them both listed for you, Scott.
Yeah. So what I find interesting about the CRB index and the dollar index is that they've basically have been going up together since 2021, going into the highs there in 2022. And generally, strong dollar would put pressure on commodities, whereas a weak dollar would kind of put a little bit more wind in their sails.
A historical inverse correlation. What do you suppose that's due to? That is a class. There's so many, like, I guess, foundational pieces to the market. One of those is a strong dollar, bad for commodities. And here you're witnessing, as you mentioned, since 2021, strong dollar, strong commodities. And you kind of have to scratch your head, go, well, why is that happening? You got any thoughts on it?
It probably has more to do with interest rates. and the demand for U.S. Treasuries in the U.S. Because if I'm not mistaken, we were one of the first central banks to start really raising rates.
Yep.
So when you take a look at the performance of the dollar index, that's a key thing. Is what's our lending rate compared to other central banks. But one of the things that I'm watching pretty closely here, which could exacerbate any moves in commodities, would be this range that we've been in the dollar index going on now for about 5 or 6 months, which is between that about 106 to 100 level on the dollar index. So breaking down below that area, the question is that going to actually put some upward pressure on commodities? Or if we break out above that area at 106, do we see some downward pressure on commodities? Because that would let us know, for instance, that previous inverse relationship or inverse correlation would be returning back to the marketplace, as opposed to continuing the positive correlation between the two. I tell students all the time, correlations, they're nice when you see them, take advantage of them, but they come and go. And you have to recognize those changes when they take place. So those are a couple of levels that I'm watching to see what the reaction is there in the CRB.
With the CMT program, Charter Market Technician, what weighting or emphasis do they put on pattern recognition and chart formations? For example, I look at this dollar index on a weekly or even a daily, and we've drawn out a head and shoulders pattern on it. And I don't know if there's any relevance or if it's just smoke and mirrors to the CMT guys, but what's your take on something like, if you look at the weekly going back into April of 2020, you got your left shoulder, you got the head, you got the right shoulder, and we're sitting right at the neckline right now, essentially predicting or forecasting a drop down to around 88, 89 on that dollar index. And I don't know if you put any weight on that or emphasis.
I'd have to see your chart again. What were those dates once more? What time frame are you on?
I'm on the weekly with the dollar index. And basically using a neckline of right around 101, looks about right around 101.22.
Okay.
But you can see.
So that left shoulder going into the May 22 highs and dipping down into the May 22 lows before advancing higher.
Yep.
So there is kind of that pattern there. And when it comes down to it, to answer your question first, I mean, those are some of the first things that you learn in the CMT process is trend analysis, pattern analysis, and when it comes to patterns, not just recognizing the pattern itself, but also understanding how to measure those so that you can determine possible price projections and how far that market might move if that pattern completes. And that right there is kind of the key, is whether or not that pattern completes.
Yeah,
right.
So that'd be a doozy. I mean, that's a pretty significant decline from. I mean, at current levels, that would be a drop in the dollar index of 12%. Which for anybody who trades Tesla, that's just called Thursday. It doesn't matter. But if you're trading a currency, especially one against a basket of currency, a 12% drop is like monstrous.
So there's a couple of different ways that we could plot this out, right? So we're talking about like the high from around 114 down to those lows around 100, and if you project it from that low, you're talking about the dollar index getting down to about 87 cents, maybe 86. Yeah. Whereas if you project it from the high there in March, we're looking closer to 92 cents, and there is an area of demand down there around 93 to 91. So I'd probably be a little bit more inclined to look at the dollar index of that area. But to your observation, because you see this pattern developing on a weekly chart, it could potentially be more significant, right? Because what it would be doing is reversing that uptrend basically that's been in place since December of 2020. And but what's even more fascinating about that is that when you look at, like, if you step out and you go out to a monthly chart, even if we do go through that level of correction, all you're doing is just correcting that impulsive move. In order to actually change the structure of the dollar index and its trend that's been in place since the lows of 2008, you'd have to get down below 88 cents. And I think that in itself would probably have more implications from a secular standpoint, because that could give us an idea as to what direction that trend is actually going to be over the course of the next decade, as opposed to just maybe the next year.
Music to the ears of the long-term investors out there. The next decade,
right?
Long.
It's amazing that Jim Rogers never got into this stuff.
Yeah, no, Jim, he doesn't do anything with it.
If you're listening, Jim, love you, buddy.
Are you a fan? Are you a fan of Jim Rogers?
Jim Rogers?
Yeah.
So I'm a fan of any market wizard.
I like that. Good.
To me, I don't care how people make money in the market. I mean, they have a skill and they exploit it.
Yeah. I'm a fan, just so you know. I actually interviewed. I had the privilege of. He was one of the nicest guys ever. I actually met him at a Freedom Fest in Las Vegas, which was an interesting one. And
was he there on his bike?
No, he was there just walking around, shuffling around the floor. But, he's so nice to everyone and just very friendly and open. And I asked him, I said, hey, would you mind coming on the show? And he's like, yeah, no problem. Just say when and where. And he was so respectful in the show. But it was, nice. It's interesting because I've met some other people in the industry who are the most conceited, pretentious, cold-hearted assholes I've ever met in my life. And, here they are, these big wigs in the financial markets. And it was so nice to meet him. It's refreshing to have someone who actually treats you like a normal human being, even though I'm nothing in the finance world. All right. Anyway, I had to give him a little bit of a plug. So Jim Rogers, we both have a level of respect for. Jim Cramer, well, that's a different story. By the way, you know that there's the inverse Jim Cramer ETF, right?
Yes.
So this is human.
How's that been doing anyway? I haven't even looked.
It's actually not been doing well, which I guess is good for Jim Cramer. But there's kind of this joke out there that every time he says he's bullish on something, it goes to hell in a handbasket. And every time he says he's bearish on something, it has this huge market rally. So I guess he tweeted out, I'm bullish on the inverse Cramer ETF. And some guy posts, oh, the markets are done now. He's bullish. Yeah. He's bullish on the inverse one, which means that the inverse one will go down in value, which means his picks would actually be going up in value. Gotta love the psychology of that one.
I think he's going to start trying a little harder.
Yeah, or maybe being less influenced by the people paying him to make these picks, but that's a whole different story.
Right.
All right, let's go to your last one out there, which is going to be currencies. Now, I really haven't seen anything on the currency front that just screams. Well, I mean, one of the things we love about currencies is the trends that can form. And, we've had a great trend in the British pound. Actually, let me bring them up for to viewers at home.
Yeah, the pound dollars, out of the majors, that one's been doing the best.
Yeah, it looks fantastic
over the course of the past few months. But what's funny about, for instance, the pound dollar, and again, I always, whenever I go through the back report, and I probably sound like a broken record, but I always look at monthly charts, and when you take a look at where the pound dollar is right now, like it's in a corrective phase relative to this magnificent downtrend that's been in place since 2007. And so when I go through this process, and I tell students this all the time, like whenever I look at a trend relative to whatever time frame I'm analyzing, I always tend to ask the question, what direction is it going first, right? Up, down, sideways. But then the other part is what's the phase of that trend? Meaning, are we in that impulsive or corrective phase within the market? And when I plot that out, because I'll just draw swing lines, just connecting the highs and the lows, just to get that visualization of it all, and kind of filter out some of the zigzagginess of the short-term price action. But when I look at the British pound and I say, all right, well, yeah, it's in a corrective phase. Well, how far could that corrective phase go? How far did the last one go? And so the last major corrective phase that we had was October 2016 through April 2018. And when you take a look at the British pound, like the target, if you're just using a 100% measured move there, you're not even going into like the fib extensions at all, but just an equal measure move still gives you a target on the British pound at 130.97, right? Let's just call it 131, $1.31. So when we see that termination of that impulsive phase of the monthly chart terminated, which was back in November of last year, then, your kind of shorter term to intermediate term sentiment would shift from trying to either join that downtrend, the bigger picture downtrend, to saying, okay, let me go ahead and find some areas of demand and try to take it back up to that 130 area, if at least, if not a little bit higher, because there's some other levels in and around that 136 going up to about that 138 spot. So
it's funny. It's just, this is for my own personal question. So, you like to do kind of the measured move. So that bounce you mentioned that goes from October 2016 to April 2018, that was a 20% bounce. So you are taking the full line, moving it over and saying, okay, if we get that same bounce up, we should be somewhere right around, call it 128.70.
In terms of points.
In terms of points, right. But, but that, see, and I don't know what's right or what's wrong. That would be almost a 24% gain. I am more of in mind to say, if it bounced 20% last time, what about it bouncing 20% this time, which would actually put it exactly where we are right now, which is right into an overhead supply zone that goes back to May of 2022.
Last year, yeah.
And of course, you and I know this phrase very well. If you torture a chart long enough, it'll tell you whatever you want to hear. But, in this case, I'm looking at it saying, well, this is a 20% bounce. Here's a 20% bounce, and it's right into overhead supply. Which one's right here? Is it about picking one and sticking with it?
I think all of them are right. It's like I had a student the other day ask, it's like, hey, can I go long here after I just talked about going short? I'm like, you can do whatever you want to in the markets,
right?
And the thing is that the only thing you're ever going to know is where you're wrong. So for instance, like for me, if I'm targeting that 131 area within the British pound, and I take a look at where the trend is right now, I have to ask myself the question, where's the critical swing low on the daily chart, and currently it's sitting at about $124, right?
Yep.
So that's where I would be wrong, right? And from, let's say, for instance, from the perspective of somebody looking to initiate a short because they think that this market is overbought, it's already bounced more than 20%. We're at supply. I think it's going to go down. There's a lot of different ways of approaching that, right? But one of the things that I learned, again, going through the CMT process, was in Dow theory, right? And within Dow theory, there were 6 major tenets that we had to study and really understand. And my favorite one, to paraphrase, was trends continue until they reverse. And when I read that, I'm like, well, thank you, Captain Obvious. Right. But really, the thought process was that if the trend is up, keep looking for buying opportunities. Right. If the trend is down, keep looking for selling opportunities. But more importantly, recognize where that trend reverses, and you need to either stop buying or stop selling. And so for me personally, I would, if I'm looking to initiate a short position, like the way that I would handle this is I would say, okay, well, I do have an area of supply out here, right? And maybe that area of supply on the daily chart centered around that 126 to 126.69, 126.70. I'd have to say, okay, well, where would that move that took the market up to that spot, where would it terminate? And off of a daily zone, I would actually have to drop down to like an hourly chart to see where that market structure is and say, okay, well, the major swing low versus where we are right now, there's a couple of spots here that I would actually watch. It'd be 125.78 to 125.60. And if I'm looking at that, I would then say to myself, okay, well, if we take out that low, then what I would look to do is if we're starting a new downtrend, right, kind of going back to what I just said about the Dow theory, is that, trends continue until they reverse, right? And so if I'm initiating a short and I get short at 125.78, I have to say to myself, well, if I'm short, what should the market not do?
Right.
Well, it shouldn't trend higher, right? So if it made a higher high above that 126.79, I know I'm wrong. I need to get out.
Right. Have a stop in place, no problem.
Yeah. And so that's 100 pips, which, to a day trader, that's a mile wide. They're never going to do that, right?
Right.
But for someone that is looking at a currency potentially, going from that $1.25, let's say $1.26, all the way back down. Let me break out my fib extensions here. So the way that I would measure this out is I would measure from the highs there in June of 2021 to the lows of September 2022, and then project that from wherever the new swing high is that terminates that minor uptrend.
Right.
and project it from that distance. And so that would give me a target down around 87 cents, 88 cents. And so, would I risk 100 pips to make what, 4,000?
Yeah.
Right. I think the answer is yes.
Sign me up all day long.
Right. And the other part of that is, understanding, okay, well, again, what's the duration of these moves? Like if we look at the impulsive move there, from the highs in July 2014 to the lows there in October 2016. I mean, that was a move that lasted for 2 years, over 2 years, right? This last one from May of 2021 going into September of 2022. Again, that's a longer term move. So somebody looking to risk 100 pips to make 4,000 over the course of the next year and a half, 2 years, that's a longer term perspective.
Yeah, absolutely. And I'll be honest, it's tough to stay in anything that long. I can't. Unless it's Bitcoin. It's Bitcoin, I can't stay in it that long.
Well, and that's where I think the biases can help. Like once you have it, biases can be dangerous in my opinion, right? But once you have a situation where you initiate a position, the market is telling you that you're going in the right direction. The hard thing is sticking with it and using price in a way to continue to confirm that you're on the right side of the market, without getting too excited, right? But just like we were talking about earlier with the S&P 500 and how far those levels are away from the position, like if you're using a trailing stop on the market, you might have, let's say, a target out at 88 cents on the British pound, but if the market just kind of like gets down there and takes you out, that's great. But what if it didn't, right? I mean, you have to have some sort of a method to trail your stop. And sometimes, and I've gone through this quite a bit to where you're looking at it and you're like, wow, I'm up X, but my stop is at X minus 4. And that would mean I'm giving up anywhere between 40 to 60% of the profit that I've built into this.
Yep.
But it could also mean that if you get out now, you're cutting yourself off, right? It's like, do you want to eat your marshmallow now, or do you want 2 marshmallows in 3 hours?
How about if I don't eat marshmallows at all? But I get your point.
Yeah.
The sugar is getting so expensive.
You've heard of the study, though. You've heard of the study.
Absolutely.
And I have to remind myself that all the time, right? But it was a study that was done. I can't remember over how many decades, but they were basically studying those that would eat the marshmallows right away, or those that would wait, and where they were in their life, and how much more or less successful they were in their academic as well as their professional career, and the statistics just pretty much shown that, look, if you could be a little bit more patient, you're probably going to be better off in the long run.
Yep, gotta love it. Patience. And don't eat those damn marshmallows. All right, so let me real quickly show you guys something here. We've gone through the B.E.C.C report, which I'll show you the graphic there so I can transition appropriately. Bonds, equities, commodities, currencies, lots of action going on. Of course, for those of you who are part of the Online Trading Academy community, you know who Scott is. Here is his upcoming schedule. Look at that. Instead of me asking you every time.
What?
Yeah, right. I figured I just made to show the calendar.
How'd you get that? I don't even know my schedule.
Well, let's tell Scott what he's teaching, shall we? Typically, he's doing a GPS mastermind session. You can see that's scheduled typically for Mondays and Wednesdays. He also has a GPS session on Fridays, which is open to a different group of students. He's got XLT stock trading typically on Mondays at 1 p.m. And every now and again, he's doing some more all asset mastery at 5:30 a.m. on. That was this week. So tomorrow morning, you're doing an all asset mastery at 5:30 a.m.
Yeah. So I don't do those very often. I think it's been about a month or two since I've done the one before this, but I did one Tuesday morning, doing another one tomorrow morning. But for the most part, 3 days a week, Monday, Wednesday, Friday, I host the GPS session. Some weeks it's the full hour, other weeks it's just a half hour. But yeah, I'm out there. XLTs and GPS is generally where individuals can find me.
Sounds good. All right, man. Well, hey, thank you. I appreciate you coming on and sharing some insights, your monthly B.E.C.C report. I'm going to try to do it once a month. I know I hate to bug you to do it, but I think you like talking about it.
Once a quarter, I think is probably appropriate, because there's not a whole lot that changes. I told people this last week when I went through this. It's like when you look at the markets on a day-to-day basis, like if you're a day trader, yeah, things can change. But even you can enter periods in time like this where the S&P is just going sideways for weeks, right? Well, same thing holds true on the monthly charts as well. But the key thing is that when you see the change, right? When that change happens on the monthly charts, it's important.
Yep. All right. Well, maybe we'll stretch it out to once a quarter. Either way, it's always great to talk to you. Thank you for taking the time to come on today, and I look forward to talking to you again soon.
All right, man. Thanks for having me. Take care.
Guys, that was Scott McCormick. He does a B.E.C.C report. Well, it's something he's done for the longest time, but he just kind of does it for himself. It's bonds, equities, commodities, and currencies. I like having him on because it kind of just reinforces why I need to look at all these different pieces and how they function together. So hopefully you guys enjoyed that one today. I was going to go do some more stuff here on the show today, but since it's 4 minutes for the hour and I have a hard stop, I have a phone call I have to take at 3 o'clock with my tax guy, I will be ending the show here rather abruptly. So I won't run through our overall markets for tomorrow. I guess I could real quickly look and show you the economic calendar because that is somewhat important. So let me bring up your economic calendar for mañana. Hold on one second here as I bring this bad boy up. Go to the calendar and we'll go to tomorrow's calendar because there's a ton of information, particularly if you're trading the British pound. The British pound is really the most active thing out there tomorrow. You're going to get bored with all this, but you have the Bank of England monetary policy report. You have the MPC bank rate votes. They're going to have a rate announcement all happening at 4 a.m. And then later on that day, they're having an NIESR GDP estimate, plus their GDP numbers, plus trade balance, plus industry services. It is a monster day for the UK tomorrow. Most of it happening at 4 a.m. Pacific time. So that will be this to kickstart things. Then, of course, for us, we have the PPI data, which comes out at 5:30 Pacific time. That'll be 1 hour before the markets open. And that is, I guess, will be widely watched. We saw how volatile that CPI number came out today. We had the markets just shot straight up on that announcement. And since I'm here, let's go up and bring that up. Go to the S&P, just show you on a 5-minute, because I'm sure you all saw this, but there's your CPI announcement release, ripped up to the upside, and all of a sudden just started tanking, pretty much gave it all back. So, and then rallying again. So a lot of uncertainty based off that CPI number. What's the Fed going to do? What are they not going to do? I don't expect it to be much more volatile than it is today, but I do expect there to be volatility when that announcement comes out. So expect whipsaws, be careful, err on the side of caution. And for tomorrow's show, I don't have a guest, so I will be diving into the mailbag, which I did not get to all your questions today. I apologize, but just got a little too much going on here today, but I'll get to all those questions. I'll probably do a Q&A show tomorrow, unless you guys have a specific topic that you want me to address. If you do, send it to TraderMerlin@gmail.com or put it down below any of the videos out there. What did Tom say? Kramer called CMG to go to 2000 on April 17th when it was at 1740. Surprise. What did CMG do? What did old Chipotle do? It made it. What are you talking about? He actually made it did what he said it was going to do. That's incredible. Say it ain't so. Yeah, right, Oliver? Unbelievable. Holy cow, he got something right. Went to 2000. Wow. You know what? Good for him. Even a blind squirrel can find a nut every now and again. Okay, that's going to do it for me. I'm going to wrap things up here. As I mentioned, I got a phone call in 120 seconds. So I will see you guys tomorrow. Thank you so much. If you have any feedback, email me, let me know, and hopefully I'll make that a show for tomorrow. Take care, everyone. See you tomorrow.